Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
On July 16th, 1858, that'd be 162 years ago, Abraham Lincoln offered a transcendent message. He said to all of us that a nation divided against itself cannot stand. Truth is, this was not his message. And the other truth is, there are no new meaningful messages. There is just the truth about what makes mankind better. And then there are transcendent messengers like Abraham Lincoln who remind us along the way of that truth. Jesus is the one who originally talked about the kingdom being divided. He said that every kingdom divided against itself will be ruined, and every city or household divided against itself will not stand. We all know this fundamentally is true. When we are not together as spouses, significant others, as families, when we're not together as a community, when we're not together as a nation, when we are fundamentally divided, those events lead to outcomes, let's just say, that none of us want to be a part of. I'll remind you also of another truth, and that is that God is for every one of us. He's not for everything, but he is still for every one of us. And so today, I'll tell all of you and remind all of you that a nation divided, a family divided, a business divided, it cannot stand. And we all need to do exactly what God has done for us, which is to be for each other, particularly in this season that we're all going through. That doesn't mean we have to be for everything. We don't have to be for everything, but we still need to be reminded, and I'm doing it for all of us today. This is News You Can Use, to be for everyone. All right, let's get on to our program. Start out by reminding all of you what we do at Supreme, and that is our vision. This is where we want to become and where we want to go. That is, we want to become the best mortgage banking company in America, not the biggest, but the best. How we think we'll get there, the road we'll travel, it's to live our lives selflessly. And that's not natural. To serve others before self is terribly unnatural, but it's better. Our inspiration, our partnership with you is to deliver to you and to your customer the industry's best customer experience. I will remind you also that we have a program called Personal Professional Best, because our whole company's motivation is about becoming our personal and professional best. And we invite you to join us on that journey. Coming up here soon, we are going to be talking about relationships. And why is that? Because becoming your best in life, it starts and finishes with relationships. And we have one of the great relationship connectors and builders of all time joining us on our program in the month of October, Gary Chapman, who wrote the 5 love languages, really to teach us all how to love each other better, meaning the bridge, the differences that we have. All of us have them, but Gary brings enlightenment to how to love others, if that's what you intend to do in life. And I certainly hope you'll join me in doing that, because that's how you become best in relationship, is to love one another. And by the way, that's another truth that was offered to us before time began, which is that we are to love each other, love our neighbors without condition. Let's move into other news, shall we, about the economy and about what's happening in our industry, housing and housing finance. Let's start with, well, the story of the year, 2020. We induced a coma. That's right. When we found out that we had this thing called COVID-19 show up, the coronavirus, and we knew that we had no vaccines, and we really hadn't had a way to treat it in the past because, well, it was new and it was classified as a pandemic, which means it was spreading across the world. We knew that we had to do something, well, pretty dramatic, and that was to induce a coma. And why? Because we wanted to flatten the curve. Simply put, we did not have the medical equipment. We were not prepared for this event. So the idea was to induce a coma, shut down the economy, shut down bars, shut down restaurants, shut down stadiums, concerts, planes, hotels, cruise ships. Almost everything got shut down earlier this year in the second quarter. And all of that was to slow the spread so that we could get better prepared to deal with something that's not going to go away anytime soon, and that is COVID-19. But we needed to slow it down. When we did that, we created unprecedented impact in the economy. Unemployment claims to date, 64 million. We only have 160 million Americans that work. 64 million of us have at some point now filed an unemployment claim this year. Unbelievable. Our rate of unemployment started the year at an all-time low at 3.5%. It went to 14. Fortunately, it's back down to 8.4. I didn't think I'd ever say, fortunately, we've made gains to 8.4%, but that's exactly what's taken place. That's what happens when you shut an economy down. It just doesn't start back up. Interest rates, beneficial to all of us in housing and housing finance, went down as a result of the economy declining in terms of its growth. And boy, did it. In the second quarter of this year, unprecedented, 33% fewer dollars moved in the economy. Cash registers rang up 33 cents less than they had the previous quarter. That's unbelievable. It happened. We all lived through it. And by the way, we now know we can live through an awful lot of adversity because we did, although we're still in the middle of it, but we need to fight our way out. Housing sales, they went down 33% as well, except then they did something that no one expected. They not only recovered, but now we're actually forecasting, according to our good friend Doug Duncan, who was on our show last week. If you did not see it, the chief economist with Fannie Mae joined us to tell us good news. I'll share that here in a minute. And finally, because of the event of shutting things down, we needed to get money into the hands of employers, PPP. We needed to get money into the hands of those that were unemployed, filing claims, additional dollars. And we also gave money to almost every American. In fact, under $100,000 in earnings, every American got money. And all of that helped keep the patient, the economy, with blood flow until which time we could get it reopened. And we're still in the middle of doing that as we speak. Let's move forward and talk about the restarting and what's happened since we've restarted. It's been a pretty fascinating story, actually. We've moved to another alphabet letter as a potential idea of what the recovery, and this is what's been forecast all along, which is, okay, we shut the economy down. We have never done it in the past. So what happened? All the economists went to work and started creating ideas about what a recovery might look like. You know the story. We've talked about it. V, which is what we want, go all the way down, come right back. That's victory. And then there was the U and the W and the swoosh. Nike got in there somehow. A radical sign. Took us about 3 weeks to figure out what that even was. The one that is really now emerging as the story, at least for now, is the K. What does that look like? The economy goes down, and then the recovery takes place for certain people, and for others, not as quickly and not as much. We'll hope that that K ultimately gets replaced by something else that's better than that. But for the time being, it really feels like the K is kind of fitting the circumstances. And I'll share with you details on that here in just a few minutes. We told you at the beginning of this event, when we went into a coma, that there was really fundamentally three things that we needed to watch in order to determine the outcome of what type of recovery we would have. We needed the Federal Reserve to use their considerable influence and power in monetary policy. We needed Washington to actually not be divided. Maybe we asked too much, but we needed them to do some things. And finally, we needed to get the entire nation and world's medical companies, doctors, leaders, we needed to get them to focus on what we could do to treat it and to get a vaccine. In fact, we have something called warp speed because we're working towards trying to get a vaccine in record period of time. Okay, let's talk about how they've done. The Fed has done amazing work. We've told you that from the beginning. They got in early and they dropped interest rates, and then they started buying securities in the marketplace, debt in the marketplace. They bought debt from the mortgage industry. They bought debt from the federal government. That's right. The federal government bought debt from itself. Fascinating. Why? To drive interest rates down and to create liquidity. They bought municipal bonds. They have done everything you can imagine to make sure that blood flow continued to take place with the economy. Let's talk about what happened with fiscal policy in Washington. They got off to a good start, frankly. They did. They got together immediately, and we had a payroll protection plan, which was to give money to employers so that they could keep people on the payroll. They also subsidized additional unemployment benefits so that those that did file for unemployment would have even additional dollars in their hands. And again, they created stimulus. They gave money directly to people. They created forbearance. They did an awful lot of things in the CARES Act. And then we needed them to step back in about 60 days ago as many of those programs expired. And of course, they started to act like Abraham Lincoln told us not to, like a house divided. And we are still divided on a number of different things. So here we go. Unemployment benefits, they've kind of expired, and the president tried to do some things on the margin, but not as beneficial as was first time through. Stimulus checks, the second round did not take place. And a lot of people are still waiting for the first round of help because, of course, again, let's just say the government doesn't always execute. And by the way, this was a big ask. It was a big ask because we needed, at a time when we are more divided than we'd like, we needed them to collaborate and then execute. And this was a big ask. Let's just put it that way. Over the weekend, Nancy Pelosi, Speaker of the House, has said now that maybe there's a window of opportunity to do another deal. We'll see. She shrunk her deal now from 3 to 2.4 trillion. The Republicans still got a long way to go to get to meet, but let's just hope that they are listening to the program today, that a house divided against itself cannot stand. There's so many Americans that are in need right now. We have 8.4% unemployment. That is, by the way, about 7 million people more without employment than when we started the year. Those are our brothers and sisters. They're our friends and Americans, even though we don't agree with everything that they think. We are still for them. We need something to happen here. All right, let's talk about fewer than 10%. Listen, one of the things from the very beginning is we've gotten a lot of information on coronavirus, and this is not to blame anyone. This is just the facts. Wear a mask, don't wear a mask. Wear a mask, don't wear a mask, right? There have been so many, it's airborne, it's not airborne. Yes, it is airborne. So, but that's because this is new. And it's also because the medical industry is a medical practice. They practice this, right? And so they learn new things over time. And I think in their best of intentions, they've been trying to, the best they know how, give us the best information possible so all of us can stay safest. But what they're saying now is they only believe that 10% of us have been infected. We can debate that for a long time. I will tell you this, I guarantee you this will change too. So the bottom line is this: where are we with this thing called COVID-19? Well, here's where we are. The good news is the tests continue to take place daily. The other news is we've kind of flattened out on cases. They went way up to almost 70,000, 80,000 a day, and then they went way down to below 40,000, and then they're back around 47,000. I think a lot of that has to do with kids going back to school, et cetera, et cetera. We'll get to that here in just a moment. The other news is that hospitalizations have kind of flattened out. And that is good news, because what we know is that the lead indicators, new cases, the lead indicators, hospitalizations, ultimately wind up becoming the lag, which is deaths. And so we want to see this number continuing to go down. And the good news, last 7 days, we're at 750. Those numbers are trending in the right direction. We'll hope that they continue to trend in the right direction. And we'll also hope that new cases stay flat, which will keep hospitalizations flat. And since we're treating it better, we have better therapies today, deaths ought to go down. And who's getting the disease matters. And we'll get to that point here in just a second. Again, here's another kind of picture of what's going on, particularly in the Southeast, Texas and California, some of those populated states in the country. And the most recent, during the summer, areas of the country that really took off, meaning that COVID finally got there and it spread very quickly. We saw that certainly in Florida. Florida was a leader, so was Texas, and so was California. The good news is that this is kind of flattening out. And look, we all know by now the story, right? Wash your hands, wear a mask, keep your distance. It's not that complicated, all right? Wash your hands, keep your distance, wear a mask, love your neighbor. That's what we're all supposed to do. I mentioned a few minutes ago, and I think this is really, really important information for all of us kind of to absorb, because it tells us, informs us a little bit about, how to best manage ourselves so that we keep ourselves as safe as possible. These are COVID deaths, and by age. You can see basically that when you get to age 65, there's 73% of all the deaths that have taken place so far are age 65 and above. 73%. If you take 55 and above, that's 84%. That means only 16% of those below the age of 55 are counting where we're counting deaths for only 16%. So the death numbers are really, really low. And if you're a college student, look at 15 to 24. You're a college student, 353 deaths so far since COVID showed up. It's not that any one of them didn't matter. Every one of them matters. But the point only is we have millions of young people in that age group, and they do what young people do. They go to bars, they go to restaurants, they want to hang out together. Okay? So anyway, let's not shame people for being, what God made us to be in relationship with other people. We all need other people. We need physical touch. Gary Chapman, five love languages, will tell all of you about that coming up here soon. But there is a reason for all of us to pay close attention. I told my dad and my mom, who I love dearly, early 80s, both of them relatively healthy, but the data tells us that they need to be particularly focused. This is also kind of an indication that the flu, influenza, and the death rates for certain people are about the same. So the age classes for the flu, those that get cases and then those that die, are about the same between influenza and COVID. So what's really happening is that we have a lot more younger people that are going to get it, and the death rates will therefore, on an absolute basis, likely continue to come down. Why? Because young people that get it are a lot less likely to be impacted from it, either having symptoms or die from it. As you get older, and your body winds up having other issues going on prior to getting either the flu in the past or COVID, those folks just need to be particularly careful. And so if you're over the age of 50, or if you're over the age of 65 or 75, and you have an underlying illness, you need to be very, very, very careful right now, because we have learned how to treat the flu better. Although it is a killer in our country, we learned how to treat it better. We're getting better at COVID as well, but we're not where we need to be. Let's check in on the other patient, shall we? And that's the U.S. economy. Let's talk about the vital signs: unemployment, retail sales, stock market, and housing. These are all key indicators, not only about where we are today, but where trend-wise we've been and where we're going. All right, we talked about starting the year 3.5% unemployment rate. Today, we stand at 8.4. Actually, that's a significant improvement. We got up to almost 14% 4 months ago. So we've made improvement every single month since. But what's particularly important news that you can use is one of the reasons why we're seeing housing do so well, particularly in our region, is that the Georgia unemployment rate isn't 8.4, it's 5.6. Florida is 7.4 and North Carolina 6.5. By the way, these are materially better than the 8.4, the nation's number. By the way, New York, 16%, New York City, 16%, California, 11.2. So the answer to the question is it's better to live in the Southeast right now from an employment standpoint. And certainly that's playing the story all the way out through housing. Initial claims for unemployment insurance, we're starting to see them flatten out. Stimulus, we need more stimulus from the government. Why? Because this would allow those, while they're still waiting for bars and restaurants and stadiums and concerts and all those things that we all want to get back to doing, those folks that serve in those capacities, they are still, a lot of them, locked out from the employment that they really need. And we need to feed them at this point dollars so they can pay rent, so they can pay for food. Come on now. It's not that complicated, is it? I talked a little while ago about the K recovery, and this kind of indicates it. The top line is for people that make more than 60,000. And you can see there was a short-term dip in employment, went right back to kind of where they were, and are kind of hovering about the same place at this point. Now, we need that to continue, by the way, for housing to continue to lead us out of this economic event that took place. Middle wage, $27,000 to $60,000. And by the way, we call that the Zoom economy, right? Because we're all Zooming now, the top wage earners. Anyway, and it's not better or worse, by the way, none of this. People make more money or less money, but every single person's service in this economy, no matter what they do, is incredibly valued, right? It's not what you do, it's the excellence by which you do it. All right. Again, we talked about the weekly jobless claims. They rose a little bit unexpectedly as stimulus boosts fade. So we kind of have flattened out now in terms of employment recovering. And we really need to see employment continue to recover, because in the end, employment, think about it this way, it's like a propeller on the back of a boat. We need the economy, the boat, to have a propeller. And so in the meantime, stimulus is kind of a propeller. So absent stimulus, we need the employment market. And actually right now it'd be great to have both. The stimulus, which would create demand, and assuming that coronavirus continues to quiet, we'll hope it does with new cases, wash your hands, social distance, wear your mask, love your neighbor. Okay, consumer spending as it goes, retail sales, we're seeing it slow. Why? Because employment is slowing in terms of its continued growth, and because we have a reduction in the stimulus. So that stimulus kept people spending, even though there wasn't a lot of places to go spend it. But we are starting to see some of that change now. I'm in Florida as we are recording today, and restaurants and bars, everything now is kind of working towards going back to normal. Again, please don't be against. If you are against us opening back up here in Florida, don't shame anyone for doing it. The answer is the tug of war has been employment versus new cases versus deaths, but I don't really believe that people don't care about whether we die or not. I think people care about, well, whether we have jobs, and they don't want us to die. And so that's why we have to do all of the things that we're doing right now. It's not an easy position for any of these leaders to be in today. It simply isn't. Retail spending, again, it did slow the pace in August. We'll hope that we keep getting some additional movement with Washington, and that we wind up with a new stimulus, which would certainly be another propeller on our boat. We need another propeller on our boat. Does everybody say amen? Yes. And by the way, even though spending was slower in August, it's still growing, an important point. So we're still making progress, just not at the pace that we need to create additional employment on an exponential basis, which is what we need. All right. The market volatility, it's expected to continue certainly this week. Presidential debate, wow, there could be more viewers than the Super Bowl. Certainly, there'll be a lot of viewers, that's for sure. And the jobs report is coming up this Friday, so we'll kind of get another indication. My expectation, the market's expectation, is certainly that we're slowing in terms of improvement, but that we will have on the margin created a number of new jobs. All right, let's continue to talk about what's going on in the market, shall we? The stock market, that's generally a tell for where we're going. We had a correction recently, but we're still up for 2020, which is, to be honest with you, after everything we've been through, 3.5% unemployment, 8.4%, shutting down the economy, putting it in a coma, it's pretty amazing. But we are still up for the year, and we'll see where we go next. Listen, this is the media at its classic. The stock market's still up, but a crash could be coming. Of course a crash could be coming. But come on, can you at least give us a break? Can we celebrate for a minute that the stock market is up? Thank you. Let's just celebrate. Let's just leave the second part of that headline off. How about that? Housing and housing finance. I think that matters a bit to you, certainly does to us. Let's talk a little bit about where we're at. Let me say this. We had that major decline. We have a V. Look at the V. See the V? See the V? Oh, isn't it beautiful? Victory. That's what that looks like to me. Victory. This is purchase applications. We were having a pretty good year. Doug Duncan, our good friend at Fannie Mae, told us that we would be up 2.7. That's when we started the year. And then we wound up having the event of the induced coma. And just like every other industry, we went down. We all held our collective breaths. And guess what? Housing now has been the shining star in an otherwise challenging economic environment. We've seen a major recovery, so much so that Doug is now projecting that we're going to be up for the year. That's right. And housing still up for the year, even having gone through a 30% plus decline. We also have new home surges, new home sales surges that are at the fastest pace since 2006. Don't be alarmed that we use 2006. Yes, the market didn't do so well in the couple of years afterwards, but we really actually make sure people have jobs now in our industry. So the bottom line is that we were up substantially in the month of August in terms of new home sales, and that's a good news story. What that tells us is that demand in both resales and in new homes, and we also had a record number of new starts, very important because all of us know that inventory is a challenge in our industry these days. So we have a record number of new starts, new homes coming out of the ground, which is good news for inventory down the road. Let's take a look at the United States, right? August closed sales, we're on an annual pace of about 6 million, a 2.6 million pace in the South region. And look at Fort Lauderdale. Tampa still up, but not as much as Fort Lauderdale, up 16%, Atlanta up 8.7. Charlotte was the only one of our markets that was off just a bit. Their economy wasn't reopened as quickly as Florida and Georgia. And there is clearly data that is confirming, as I shared, the unemployment rate in New York is still up at 16%. What we're seeing is that the states that have opened earlier, and I'm not saying it was a good idea or a bad idea, I'm just saying what's true is the outcomes are certainly better. We've seen prices increase as well. Why? Because we still have inventory limitations. We had them to start the year, and demand has exceeded what we expected it. So we actually have less inventory. And why is that? Because when Corona hit, a lot of sellers who maybe had intended to sell pulled their houses off the market and didn't put their house on the market, even though they were thinking about selling. So what's happened is inventory has gotten even more shallow as demand was better than expected, and we saw supply get even worse because of COVID. Now that's starting to correct itself as people are getting a little bit more confidence, a little less fearful. All right. A record number of borrowers are refinancing and now can save by refinancing. Look, this is a good news story. Why? It's putting stimulus in the pockets of Americans. Stimulus is good at this stage of our recovery. So every time someone refinances, they save $300 a month. That's like getting a pay increase like $6,000 a year. It's an amazing benefit for people to do so. But let me tell you what the consequences are to you and to your customers. That's right. There's a traffic jam in the lending industry. Why? Because overall, mortgage demand is up about 40% year over year. And for a mature industry, growing at 40%, there's not enough people to hire. You can't do it that quickly. Let's get down to the details of the forecast that we went through with Doug last week. Right in the middle of the page, you see that we now have a 1.3% year over year projected increase in housing sales, just under 6.1 million housing sales. Next year, even better news, a 2.4% increase from this year. Listen, based on what we've just gone through, this is a really good news story. Fourth quarter is going to be really strong, stronger than normal. And guess what? The first quarter of 2021 looks like it's going to be stronger than normal as well. So these are good news data points. And I'm very, 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 very pleased at this point. We've also seen, as we talked about already, new single family, not only starts, but sales increasing at an accelerated rate. Good news story. All the way at the bottom of the page, I want to show you something, right? So we were at 3.9% interest rates last year. We're at about 3% this year, 3.1, lower even expected next year, but drop down again. Let me show you the traffic jam in our business. Last year, our industry did $2.4 trillion of mortgage, all the way to the bottom of the right of the page. So what happened is last year, mortgages, 1.3 trillion in purchases, 1.1 trillion in refinances. Center of the bottom right is 3.8 trillion in mortgages this year. So we're up almost 40%. Purchases up a little bit because housing values have gone up. But look at the refinance number, 1.31 trillion, last year, up to 2.4 trillion this year. And next year it'll go down because we'll have exhausted all those refinances that are outstanding. By the way, this is creating additional pressure in the lending community to process your mortgages on time. It's also creating pressure on appraisers, attorneys. If you haven't heard it, you're going to hear it because it's going to impact exactly what it is that we do for a living every day. And we're doing everything imaginable to stay completely focused on delivering the industry's best customer experience for you. Why? Because you're our partners and we focus on doing what's best for our partners. Here's the interest rate chart. You can see historically, we've never been this low on interest rates. And the expectations are that we actually could go lower into next year. We'll see if that story winds up being the story, but it is certainly news that all of us could use. That is to see interest rates get even better going into next year. And again, the 30-year fixed, it's not 2.9% for everybody. That's with 25% down, with a great credit score, buying not a condo, but a single family detached. Lots of things drive that. But the bottom line is the base rates for 30-year fixed rate mortgages are lower than they have ever been. That's news you can use. If you're talking to your sellers or your buyers, let them know. It's the best time to buy. As long as they got a budget, like Mr. Doug Duncan said, it's a great time to buy. Back to the traffic jam. 56% of all of the mortgages being produced in our country today, 56%, the majority, this is as of August of this year, are actually refinances, not purchases. And by the way, this impacts you and it impacts your customers, your buyers and your sellers. Why? Because lenders can't grow their capacity as fast, 40% year over year. And who would have thought during COVID that they needed to hire anybody, right? No one. So we went up 40% in a mature business. You can't hire. There's not that many mortgage bankers. And what's happening then? Well, it's just slowing everything down. That traffic jam is slowing things down, except at Supreme. Anyway, national averages, 56%. Again, refinances, 44%. Look at the numbers at Supreme Southeast. You know what I want you to know? That you, as our partners, you matter. And I want you to remember this, because when the lenders who have disappeared, because they're eating the gray pie all the way on the left, refinances, when they come back next year and knock on your door and say, remember me, tell them, no, I don't, by the way. Start with Supreme. That's what you should do. Why? Because we're focused on making sure we're paying attention to your needs. Look, purchases are harder. They go faster. There's appraising, financial contingency, appraisal contingencies. There's buying agents and listing agents. There's specific dates you got to close. None of those things are true about refinances. So most of the lending communities doing what's easy to do today, refinancing, we're not. We're focusing on you and your needs and your customers' needs. Why? Because we are interested in delivering the industry's best customer experience. That's why the numbers are extending themselves in terms of average days to produce a loan. As of August this year, if you made a loan application in America for a refinance, it took you 50 days. 50 days to get that transaction closed. It took 45 days on a purchase, and you and I both know that sometimes 45 days is fine, but a lot of sellers would rather go a lot faster. And in a lot of cases, you got to go a lot faster. And based on what we're seeing, that's actually not going to happen. The days are going to actually extend, not get better. So very important that you're talking to your buyers today. And as listing agents, you're talking to the buyer's agents, making sure that they don't start with a stagecoach. They go really slow. You don't want to do that. See, buyers, they just believe that, you know, the best rate is the best Well, it might be, but if you can't get it in time to meet the contract, what does the best rate do for you? Not much. The best service is what they really need. All right, let's take a look at what's going on in the industry. Well, it's making wine with its mortgages. That's what it's doing, 49 days. We're not. We're getting in and out 24 days on average. And of course, we can go much faster. Now, I will tell you this, that if you are doing in Atlanta a Georgia Dream, or you're doing a jumbo loan, those loans, which are fortunately only around 5% of all the units that we do, but those loans, they're very important to us, so are the customers. They have nuances that make this a little bit more complicated to go as fast as we can with traditional, conventional FHA and VA mortgages. Those start with Supreme, we could go really, really fast. We pride ourselves in doing this because you all need us to do it. We call that the Supreme Speed Service. That's right. We can go in as little as 8 days. And last month, we probably closed, I don't know, somewhere around 20% of our transactions in less than 15 days. So if you need to go fast, want to go fast, buyer, seller want to go fast, you need to start with Supreme because we can go really fast. Let me give you a couple of do's so that you can help coach your customers if they want to go fast. Once they get pre-approved with us, they need to sign wet docs. What are wet docs? They're not actually wet, but they need to sign these documents to give us authority to check on things like employment and otherwise, right? So we don't necessarily need to do that, but if we don't do it when the pre-approval's done, it takes another day or two to get them to do it when they actually go to contract. They need to deliver to us upfront before the contract all the income documentation, asset documentation, and other requested documentation. You need to tell them, get it done while you're in the pre-approval and go to their credit essentials class, start with Supreme. Why would that be? Well, because you can improve your credit score, which will save you money when it's time to lock in. All of this are dues, and they'll save 1 to 2 days off the application when it's actually filed. Let's talk about what you shouldn't let your customers do. And we need to tell them this: don't leave your job, okay? Even if it's a better job, okay, but talk to us before you do that. Don't just do it. Don't get your credit pulled by anyone for anything. After we pull their credit, anybody else who pulls their credit could reduce their credit score. Don't buy a new car or furniture. Don't use any credit. Just kind of stay still with your financial statement until you get under contract, and delay sending. Don't do this. Don't delay sending your financial information to Supreme. We can't go as fast. When we pre-approve them, they're out looking for property. If they'll get us all the documentation, they'll sign our wet docs, they won't leave their job, they don't do any of these other things, then we can go fast, really fast when it comes time. Step 2, the contract is now under agreement. You guys get a contract, buyers and sellers agree, perfect. Now that they've done everything we've asked them to do, immediately the buyer needs to forward us the contract and make an application within 24 hours. Don't wait until Tuesday. If the contract gets done on Saturday, make it over the weekend. We're available, please, because we can save days off of the transaction. And update all your income, asset, and requested documentation. We're going to tell you what you need in the pre-application stage. You need to collect the most recent bank statements, the most recent pay stubs, because we'll need those when you hit the contract and get under contract. You need to lock in your interest rate. Don't float your interest rate, and because that slows down details behind the scenes. We don't make any more or any less money. The rate is the rate. But if you lock in, then all of the underwriting mechanisms are in place so we can get in and out quickly, go fast. And then finally, don't wait to shop for the homeowner's insurance policy. That affects your debt to income ratio because we don't know what the number is until we actually have the policy. And many buyers wait until, let's say, 2 days before closing or a day before closing. That creates unnecessary stress. You need to, please, as realtors, partners of these customers, you need to have these documents and make sure that you are repeating after me. Do this, don't do that. Do this, don't do that. Okay, that's when the contract agreement is reached. The third process is the inspection process. When the inspection is completed, send the updated contract. If there's been a renegotiation of the price, send it to Supreme. Tell the buyer to do that. You do it for us, because that calculates again the amount that we'll be lending people. And if that changed, we need to get the data as quickly as possible. Acquire the homeowner's insurance policy. Don't just shop it. Now acquire it when the inspection process, so we can get it well in advance of closing. And always operate, tell the customers, with a sense of urgency in response to documents that Supreme requests. Oftentimes, we'll ask for documents that could be had in 24 hours, and they'll wait 3, 4, 5 days. I know they're busy, but if you want to go fast in a transaction, this is what it takes. And when I'm talking about fast, I'm talking about less than 21 days, okay? And as low as 8 days, because we can't close any faster. Buyer's agents, hold your buyers accountable to the Supreme Speed Service steps we just shared. You have the opportunity to do it now that you have a roadmap that you can understand, really simple do's and don'ts. Just use those do's and don'ts as talking points as we just described them to you. Listing agents, have the seller engage the homeowners association if it's a condo. Why? Because lenders are going to require documentations from the homeowners association. If the seller calls as a paying client, they should be able to get those documents prepared earlier for a lender, regardless of who the lender is. Operate with a sense of urgency if you're a listing agent regarding the appraiser and the initial contact. These folks, as I've already said, are in a traffic jam. 40% more business this year than last year. They couldn't hire up for it. So when you don't take their call right away, or you make your schedule more important than theirs, just know you're adding days to the transaction, not necessary. Make it be sense of urgency with those phone calls, waiting for them to come in, and make your schedule available and tell your sellers to do the same. Provide comparables to the appraiser. Why? Because values are going up in the industry right now in the marketplace. Appraisers are challenged by hitting the values because the comparables aren't going to justify them in every case. So you got to be there and be present with the appraiser so you can help sell the property. And finally, be nice to the appraiser. We should be nice to everyone, but really be nice to the appraiser. They're overworked, really. All right, Supreme Rescue Service, if you haven't heard about it, if you got a loan, somebody's trying to make wine elsewhere, or there's some problem with it, okay, get in touch with your loan officer, one of the ones that's in your account. Let us give it a second look. And if we can get a pathway to success, you now have the Supreme Speed Service roadmap for how to get it from someplace else where they're trying to make wine to Supreme. And then if you want to go fast, you'll need to, right? Because it was someplace else needing to be rescued. Our data tells you a story. And our data says that if you refer, start with Supreme, your customers to Supreme, almost 99% of your customers are going to say thank you at the end, because they tell us just that. Thank you. The service was outstanding. Close on time, fund on time. Everybody in the audience, give me one amen.
Amen.
Thank you. Of course you want us to close on time, because stress levels go way down when we do, and you get paid on time. Let's see. Good for your customer, good for you, good for your bank account. 99.5% of the time we actually do that. And again, the Supreme Speed Service can go in as fast as 8 days, but we need your help because there's a traffic jam today, and we need to get all of the customers to behave a certain way so we can deliver exactly what it is that we're promising to deliver, which is the Supreme Speed Service. I want to finish where we started, which is really to remind all of you that the most important news that you can use is to be for everyone. You still don't have to be for everything. And when you watch tomorrow night's debate, I guarantee you, you will have a lot of I'm not for that. But just be reminded, we don't have to hate on other people because they think differently. We need to do what God called us to do, which is to love our neighbors no matter. So I'm for everyone, not for everything. I hope you will join me in being for everyone. As I told you, coming up here soon in October is Gary Chapman, who's going to be sharing with all of us how to love everybody better. And the way to love everybody better is to understand exactly how specifically they need and want to be loved. Join us next month for Personal Professional Best, and join us next week for our program, News You Can Use. Have a great day.